Hi everyone, welcome back to our channel. Adi here. So today we are going to, this is a training session where you are going to learn how you can do your fundamental analysis of a stock by yourself. You don't need to go to any expert or any other YouTube influencer or any other financial advisor to do the fundamental analysis by yourself. So first thing, I'll show you there are different ratio you need to understand. So whenever you do a stock analysis, you must have know about P ratio, PB ratio, all those things. But how you will calculate if it is a good P ratio or it is a bad PB ratio and all those things. So in today's training video, this is the first part. I'll show you how you can understand the different ratios of a company, and then you can consider on those factors, okay, if it's a good buy or it's not a good buy. So let's the video get started. Okay, so we'll check some of the important ratio you need to consider when you are doing a fundamental analysis. So the first one is your P ratio. You must have heard this one, price to earning ratio. Second is your D ratio, debt to equity ratio, and then PB value, price to book value. Then your operating profit margin, then ROE, return on equity, current ratio, interest coverage ratio, and asset turnover ratio, and dividend yield. So these are the important ratio you have to understand, and then you can do the fundamental analysis by yourself. So first let's discuss about P ratio. So price to earning ratio. So what is price to earning ratio? So basically price to earning ratio is a ratio. It will give you the measure of company's earning relative to its stock price. Okay, so how much earning is earning companies does related to its current stock price. So let's discuss what's the formula you have to use. So P ratio generally is your price per share, so current price per share divided by earning per share. So how much earning is company is doing per share. So for that you need which data? So for that you need your income statement of the company and recent stock price. So if you go to Screener or any other app, you can or a website, you can get that information of income statement of any company. Then for example, let's say the current stock price of a company is 100 and earning per share, let's consider for last 12 months is 2 on an average. So P ratio will be 100 by 2, that is 50. So we get now 50. So how will you know if 50 is a good P ratio or not? So for that you always have to consider that P ratio of a company should be greater than P ratio of its category or industry. So let's consider you are buying TCS. So if the TCS P ratio is greater than the P ratio of whole IT technology sector, then it's a good buy. But sometimes there will be some overvalued P that is due to the increased debt or future earning, that you have to sometimes take care, do some other factor you have to check. So but the first factor you have to check is P. Whenever it is greater than the P of your sector and industry, then it's a good stock. Okay, now comes to D ratio, so debt to equity ratio. So this ratio generally indicates the promoter's capital or equity in the company. So you know their promoter holding and all those thing information. So that is basically how, depending on that, how you can calculate the D ratio. So debt ratio is basically is your, how do you calculate your total liabilities but divided by your shareholders equity. So you can get the total liabilities from any of the website. So divided by your shareholder, how much promoter holding are there. So by dividing by that you will get to know D ratio. So what does it interpret? So if the D ratio is high, that means it is a high risk, because company generally need more borrowing of capital to run its operations. Okay, so that means the company lacks in finance. If it is low D ratio, that means the company's shareholders equity is in excess and it doesn't need to tap in any debt or finance to run its operation or business. But there are some exceptional cases where the company may need some fundraising for its expansion. So in that case the DE will be high, but in general it should be low. It should not be high for any company. If it is high, that means it's a high risk company. Then we will go to PB value. So this one most of you must have this ratio, price to book value. So this indicates the intrinsic value of a company's asset. So you check, whenever you analyze a stock, you say okay, it is much higher than intrinsic value or lower than its intrinsic value. So this one we have to check the compare your price of the stock to its book value. So how do you calculate this one? This one is simple. Your price per share, current price per share, divided by its book value per share. So let's take what you need. So you need the balance sheet and your recent stock price. So let's take an example. Let's say your current stock price is 100 and your book value per share is 125. So your PB ratio will be current stock price, which is 100, divided by 125, that is equal to 0.8. So how do you know if 0.8 is a good one, good PB ratio, or it is a bad PB ratio? So always remember, if it is less than 1, that means the current stock price is below its book value price, which is a good thing. And if it is above, that means it's above, above 1, that means it is above its book value price. So there are lots of stocks which is always, if you go to any other niche stocks, you will see intrinsic value is very high. That means intrinsic means its current stock price is higher than its book value. What should be its book value price, but the current price is higher, much more higher than that. So this one also you check, always check PB value should be around 1 or less than 1. That should be a good stock. Okay, so this one, let's understand operating profit margin. So basically operating profit margin is also known as your operating profit ratio. It is it generally defines the relationship between a company's operating profit and net sales. Okay, so basically operating margin is one of the key measure of your company's profitability. So from this ratio you can know how the company is profitable. So let's understand the formula. So in that case we have to check like dividing operating margin by net sales, give the figure which indicates your operation efficiency of a organization. So what does it mean? So let's understand, let's say your operating profit ratio, or you can say margin of a company, hypothetically saying can, let's say 25%. So what it does means that the company is generating 25 paisa profit against is 1 rupee total revenue. So basically it shows how much the company is generating profit against 1 rupee revenue. So generally if it grows over, let's say today is 25%, it goes over to 50%. So it's, if it grows over the time, that means this company is more profitable. So let's say today is 25%, tomorrow it is, let's say 75%. That means 75 paisa is company is earning per 1 rupee revenue. So that is a good thing. So if it is growing over the time, it's a high over the time, then it's a good company, profitable company, you can say. So these are the 4 ratio we discussed today in today's video. So in the next video we will discuss some other which I have already mentioned during the first part of the video, that will discuss in the next chapter of this video. So I hope you have now a better understanding of these ratios, and you can now go ahead and check different companies your all this ratio. So if you find this video helpful, then please hit the like button and subscribe to the channel. That will be helpful for me. So thank you everyone, bye.